If we have a circumstance where the government isn't able to normalize interest rates and isn't able to control their spending and continues to debase the currency the way they have now, if they lose the faith and confidence of savers, like they did around the world in the early part of the decade of the 70s, that's an if. The gold price will surprise you, the silver price will surprise you, and it'll surprise you to the upside. Apparently 35% of all the US dollars in circulation have been newly created in the last 30 months.
It's amazing.
It's not as though the US economy has grown by 35% in the last 30 months. It's that they have printed 35% of all the currency that's ever been issued in the United States in the last 30 months. Governments never dreamed that they could get away with fraud on this scale. And so, yes, I think it is different this time, Carrie. I think it's worse. At that point in time, which is to say 1967, we were terrified of the fact that aggregate government debt was 35 or 40% of GDP. Now government debt, on balance sheet government debt, is well over 100% of GDP. Mm-hmm. Off balance sheet liabilities of the United States, the net present value of entitlements. Look at me, a 69-year-old, Medicare, Medicaid, Social Security. The cost of old folks, as an example, is almost 5 times GDP. The off-balance sheet liabilities of the US government are now believed to exceed $150 trillion on a net present value basis. So yes, Carrie, things are different. They're not as good. Anyone who relies on conventional savings products will learn over the next 2 or 3 years that the money that they have in savings is worth less and less and less. My friend Jim Grant, famously calls the US 10-year Treasury return-free risk. If you think about the concept of return-free risk, it's not very attractive. Now, bonds have been a wonderful place to be for the last 40 years. They've been a fantastic place to be. When you cut the 10-year rate from 15.6 to 1.5, what you've done is you've increased the value of the principal on a yield basis 9-fold. It's been a spectacular bull market in so-called riskless assets, but people need to come to understand that that's over. I read the other day, Carrie, that the junk bond indexes, those are bonds issued by companies that have risky credits. The yield on the index of junk bonds is less than the CPI stated rate of inflation. One of the reasons, at least in the US market, why equity prices are so strong is because the dividend yields on stocks relative to bonds and conventional savings products is high. If you double the interest rate payable on savings products, you devalue by half the capitalized value of dividends that people receive from their equities investments. So I would suggest to you that a meaningful increase in the interest rate is impossible as long as the deficits stay where they are, is impossible given the current status of federal, state, and local government debt, never mind the $14 trillion in consumer debt in the United States. Impossible because of its possible impact on the housing market, impossible because of its impact on consumer credit, in particular automobile sales, and impossible because of its impact on real estate prices. Times like these require people to own precious metals and precious metal securities. Now, I'm not saying that 100% of your net worth should be in these things. The lovely thing about precious metals is that when normal people come to realize that their purchasing power is declining as rapidly as it is, precious metals prices tend to respond much more vigorously than most people believe they will. We've been conditioned to think about precious metals in the context of the last 20 years, as an example. But if you look at precious metals markets that I've lived through in my life, people say to me, well, Rick, the gold price is now 1,800 US dollars. I mean, up from 1,000. Can it go any higher? Have I missed the boat? My first bull market went from $35 to $850. What's that, 25-fold move, something like that?
Yep.
My second one was much more constrained, a very tame bull market from 2000 to 2011, where it went from $256 or something like that to $1,900.
Yeah.
If we have a circumstance where the government isn't able to normalize interest rates and isn't able to control their spending and continues to debase the currency the way they have now, if they lose the faith and confidence of savers, like they did around the world in the early part of the decade of the 70s, that's an if. The gold price will surprise you. The silver price will surprise you, and it'll surprise you to the upside. You don't have to have 100% of your portfolio in precious metals and precious metals related securities, 10 to 15%. And so when I say this is what you need to do, I can't tell you what your government's going to do. I can't tell you what my government's going to do other than something bad. But what I can think about is what I have to do. And what I have to do is insure myself against that collective stupidity called government. I would urge all of your listeners to remember the great quote from Warren Buffett, where he said, you shouldn't buy a single share of a company if you aren't confident enough in its value that you wouldn't be delighted to see it fall 30 or 40% in price in the next 1 or 2 months so that you could buy more at a lower price. So I'm looking forward to volatility. Despite the fact that I see negative real yield on my cash savings, I maintain cash, although I believe gold and silver are good cash. I regard them as liquidity. I think, Kerry, that on a net present value basis, particularly the mid-tier producers in the gold and silver space offer the best relative value that I've seen in my career. The net present value of free cash flow, and this extends to the Australian producers too. The net present value of free cash flows from developed reserves and resources at current commodity prices is the cheapest that I've seen in 45 years in the business. The relation between free cash flows and net present value in the producing equities relative to the gold price is the best I've seen it. In the last 30 or 40 years, the median has been between 1.5% and 2%. So it won't take an enormous flow into precious metals, merely a reversion to mean to double or triple or quadruple demand for precious metals and precious metals related equities. I'll leave it to the imagination of your listeners. What would happen to precious metals prices and precious metals equities prices if we saw a tripling in demand?